Welcome, everyone. So, in our lectures so far, we've really built a solid framework for the entire accounting cycle, right? We've gone all the way from analyzing a transaction to preparing financial statements and then the formal closing process. Today, we're going to add a new layer to that foundation. We're going to explore a tool that's optional but incredibly powerful. We're talking about a technique that, while not required by GAAP, you'll find is often the mark of a really sophisticated and well-run accounting department. This is the reversing entry. And really, this is one of those topics that takes you from just learning the rules of bookkeeping to actually thinking about smart process design. So let's get into it. Now, before we get into the nuts and bolts, the debits and credits, I want you to really think about the question up on the screen. In your management classes, you're going to talk a lot about the difference between being reactive and being proactive. See, the best managers don't just run around putting out fires. They actually design systems and set up internal controls that stop those fires from ever starting. And that philosophy, that is exactly the why behind what we're talking about today. It's about building foresight right into your financial processes. So, what is this complication we're trying to get ahead of? Well, it all comes from one of the most important ideas in accrual accounting. It's a concept that makes sure our financial statements are accurate, but it also creates this small but really persistent headache for the bookkeepers who have to deal with the fallout in the next month. And here it is. This is the source of the whole problem we're trying to solve: the accrued expense. Now, let's take a second and go back to something we've discussed before: the matching principle. This is the bedrock of accrual accounting, and it tells us we have to match our expenses to the revenues they helped create, and we have to do it in the same period. Now, for you, as a future decision maker, this is not just some academic rule. It's what makes an income statement a true and fair picture of how profitable a company was for that month or that quarter. Think about the classic example: employee wages. If your team works the last week of December, their labor helped generate December sales. So that wage expense has to be recorded in December, even if you don't actually cut the paychecks until January. And to do that, we make an adjusting journal entry. We debit wage expense and we credit a liability, something like wages payable. Okay, so let's walk through this the standard way without any shortcuts. It's the end of December. Your accountant does their job perfectly. They make that adjusting entry: debit wage expense, credit wages payable. Great. The December income statement is accurate. Now we flip the calendar. It's January. That wages payable account is now sitting on the balance sheet. It's a debt we owe. So January 5th rolls around, it's payday. The payroll clerk goes to process the payment. And this is where the complication hits. They can't just record the whole cash payment as a January expense. They have to stop and remember, oh, wait, part of this payment is actually for that liability from last month. And this is the point that, as a future manager, you have to appreciate. This reliance on someone's memory is a real operational risk. The payroll clerk now has to do something that's not standard. They have to manually split that one cash payment into two parts. One part of the entry has to clear out the wages payable liability from December, and the other part records the new wage expense for January. Now look, in a tiny business, maybe that's not a big deal. But what happens when you scale that up? Imagine a big corporation with hundreds, maybe thousands of these kinds of accruals every single month for wages, utilities, interest, you name it. This manual, memory-based process, it becomes a huge weakness in your internal controls. It's basically a recipe for mistakes and inefficiency. And that brings us to the solution, which is really quite elegant. To solve this very specific problem, accountants came up with a simple procedural step. It's designed to completely eliminate the need for a bookkeeper to have to remember to split a transaction across two different periods. It's called a reversing entry. Let's really break down this definition because the words here are important. The very first word is maybe the most important for you to remember: optional. This is not a JAP requirement. It's a choice. It's a process improvement. Second, look at the timing: at the beginning of a new period. This is literally the first thing an accountant might do on the morning of January 1st. And what does it do? It literally reverses. It flips that adjusting entry that was going to cause the headache in the first place. At the end of the day, this is the whole strategy right here. You're making one simple, proactive entry on day one so that a future transaction becomes standardized. You are, in effect, cleaning the slate for the bookkeeper. The goal is to set things up so the person processing payroll on January 5th doesn't need any special knowledge about what happened last month. Their job becomes simple and repeatable. Every payroll gets the exact same journal entry, and that right there is a core principle of operational efficiency. When you standardize things, you reduce errors, you speed things up, and you make it way easier to train new people. So let's talk about the payoff. Let's see how this technique actually makes the whole workflow more efficient. We're going to go back to our payroll example and see the real practical impact of putting this step into place. And you'll see the change in the journal entries themselves is pretty subtle. but the improvement it makes to the business process is just incredibly powerful. This chart just illustrates the payoff perfectly. Take a look. The work at the end of the period, December 31st, it's identical in both cases. We absolutely have to make those adjusting entries to get accurate financial statements. The difference, the magic, happens at the start of the new period, and most importantly, on payment day. Look at the left column. Payment day requires special handling. It relies on memory. Now look at the right. Because we did that reversing entry, payment day is just business as usual. It's a simple, standard transaction. We've taken the complexity out of the system right where an error was most likely to happen. Okay, let's walk through how this actually works. On December 31st, we do our normal adjusting entry. Debit wage expense, credit wages payable. Now, on January 1st, we post the reversing entry. We just flip it. We debit wages payable, which zeroes out that liability, and we credit wage expense. Now, I know this is where students sometimes pause. Crediting an expense account feels weird, right? It's counterintuitive. And what it does is it causes the wage expense account to start January with a small, abnormal credit balance. But just watch what happens next. On January 5th, when we pay the employees, the clerk makes the normal, everyday entry. They debit wage expense for the full payroll amount and credit cash. That big debit automatically gets offset by that small credit we created on day one. And the result is the perfect, correct net expense for January. And the best part, the clerk didn't have to think about it at all. It's automated accuracy. So, as a future business leader, what's the real lesson here? I mean, why should a marketing manager or a logistics expert care about a bookkeeping trick? It's because this isn't just about bookkeeping. It's about a whole way of thinking about how to design smart business processes. So let's just quickly recap the key things you need to remember about this tool. First, and I'll say it again, they are always optional. This is a strategic choice about being efficient, not a rule you have to follow. Second, the timing is everything. You post them on the very first day of the new period. Third, you only use them for certain things, typically accruals like accrued expenses or accrued revenues. You would not use a reversing entry for something like depreciation because there's no cash transaction happening later that you need to simplify. And that leads to the final point. Their one and only purpose is to make a future transaction simpler. It's a perfect little example of a great business principle. Put in a little controlled effort now to prevent a big, messy problem later. You know, when you don't get out into the business world and you're looking at a company, if you find out they use reversing entries, it actually tells you something important about their culture. It's a signal. It tells you they don't just do things the way we've always done them. It means they are actively looking for ways to streamline their work, to reduce the chance of human error, and to build systems that are more robust and can handle growth. It's one of those small details that really points to a bigger commitment to operational excellence. So I'll leave you with this final thought. This idea of doing a small, smart thing now to prevent a big, complicated thing later, it goes way beyond the accounting department. Think about it. Creating a really detailed FAQ page for a website to cut down on customer service emails, or building a standardized template for projects so that every new kickoff is faster and more consistent. The reversing entry is just the accountant's version of that same universal business wisdom. The important thing is that you're always asking that question, is there a way we can redesign this process right now to make our lives simpler, faster, and more accurate down the road?